Hi, I'm very excited to do a video on Electronic Arts because if you're anything like me, you grew up spending hours and hours playing EA games. Probably more than any other company that I look at investing in, well, this company just played such a massive role in my childhood. So I'm going to try not to be biased here because my inner child really wants to invest in this company. But by the end of this video, once I've gone through a future analysis, a financial analysis, and then the value analysis, well, hopefully we have a clear understanding whether we should invest or not. And if you're new to my channel, well, welcome. My videos are about investments that anyone in the world can make. Now, as a little boy growing up on a farm in regional Australia, you would think I'd be far removed from playing computer games all the time. But I love sport and I loved EA sports games and I was really addicted, and the endorphin rush that I used to get from playing these games, well, it was uncomparable. This love of EA games carried through all the way until I was about 20 years old. Now, that's actually really young to stop being a computer gamer because the average age of a computer gamer now is 35 years old. No, seriously. So the average age of the US gamer is 35 years old. The average number of years a US gamer has been playing is 13. And only 29% of the gamer population is under 18 years old. So in this day and age, the majority of people that are playing computer games are actually adults. Playing computer games also gives a lot of people a social circle, even if it is just through headsets. As a child, I was playing with my friends all the time through the internet. So being a gamer is accessible to most people on the planet, and it's really easy to spend hours and hours playing. So as an investment, having a company that provides computer games to these addicted people, well, it sounds like a pretty fantastic business model, and it is. Now, another big positive of the computer gaming industry is that computer games are very scalable. Now, I totally appreciate the blood, sweat, and tears that must go into making a game as good as, say, FIFA, but once it's made, well, it really only has to be made that once. So because it is software, that means that millions of copies can be made from that one build. Now, Electronic Arts has hundreds of experienced developers all working together on one game. So the years and years of expertise inside the company, well, it's phenomenal. So that gives them a really big competitive advantage because another company would have to devote huge amounts of resources just to compete with the quality that Electronic Arts can produce. Now, they definitely are not a monopoly in the space because they have Activision Blizzard and Take-Two Entertainment as big competitors. But for a new competitor to come along, or even the big tech giants to compete, well, they'd have to poach a lot of the talent away from these companies. So as an investor moving forward, I'd want to keep an eye on whether other companies are poaching talent away from EA. Something EA has been able to do for decades now is bridge the gap between sports, real-world sports, and computer games. They have strong licensing deals and decades of experience making games like FIFA, Madden, NHL, NBA, just to name a few. And this is where I think EA have a competitive advantage. See, they made computer gaming cool for all the jocks of the world, and it opened up to them a new market. So Madden 08 and Rugby 08 were my personal favorite titles of all time, but there are so many other popular titles that they've made. Now, I wouldn't be surprised if you're familiar with all of these titles. We've got Need for Speed with 150 million sales. There's Sims, 200 million sales. Battlefield, 57 million sales. FIFA, 280 million sales. And another personal favorite of mine, Plants vs. Zombies. The list goes on and on. The company actually reminds me a lot of Disney. They create or acquire a blockbuster game, turn it into a franchise, bring out spin-offs, and then profit handsomely from all the additional sales. Now, the gaming space has lots of different components. You've got esports, mobile gaming, PC gaming, PlayStation, Xbox. Electronic Arts holds around 10% market share of the entire gaming world. And that has been relatively stable now for around about a decade. So holding a 10% market share of a rapidly growing industry, I think is definitely a strength of theirs. So EA have a lot of market share opportunity to expand into that extra 90% that they haven't tapped into yet. Plus, because the industry is growing so fast, every little percent that they increase of that market share, well, it means a lot in the revenue. Their ability to produce high quality, popular games has been a feature of the company for decades now. And I don't see any obvious reason why they just cannot keep doing it. They have the expertise, they have already built strong relationships, and they have the budget to get licenses. Sure, Activision Blizzard is the biggest producer with EA coming in second, and Take-Two Entertainment are also a very strong competitor. But I definitely think there's room for all three. And by the way, I'm actually going to do my next video on Activision Blizzard, just if you're interested. The computer game world is moving towards more of a subscription-based, say Netflix-style business model with in-game spending. So this, I think, will help EA make more money, and the money will be far more reliable with those monthly cash flows coming in. So in-game purchases actually make a lot of money for EA. Plus, the subscription-based model gets their cash flow to be far more reliable as well. And with more people spending a lot more time at home in 2020 and potentially 2021 as well, EA has actually been one of the few companies that has really benefited from these strange times. And don't forget, we are going through an esports revolution right now, and that's going to generate a lot of revenue for the future for EA. Now, the results that I'm reading here are the Q2 results, and Q3 is actually expected to come out very soon. So please make sure you check that if you're very interested in Electronic Arts as a company. So for Q2, revenue was up 29% to $1.39 billion, and earnings per share smashed expectations, coming in at $1.25 per share. It was expected to be only 93 cents. This is what the CFO had to say. We saw extraordinary levels of player engagement through the first quarter, far higher than we even ever expected or had forecasted in May. The CEO then had this to say. Our EA Sports Live services are acting as social networks for sports fans around the world, and the strength of those connections will grow as real sports seasons return. Players in our communities for The Sims, Apex, Star Wars, and more are building relationships through our games, and we expect them to be with us for a long time to come. Look, CEOs are always very optimistic people, but I just love how the industry is trending in the right direction for all of the computer game manufacturers. So I actually don't see that many threats for EA as a whole. Activision Blizzard and Take-Two Entertainment are strong competition. You've got Microsoft and other companies like that in the space as well. But look, I think the competition is healthy. I do think the barrier to entry into the industry is high. And look, EA have been doing this for decades now, and I'm very confident they can stay at the cutting edge. So looking at the industry that Electronic Arts is operating in, I just see really positive signs for future growth, and I don't see it going away anytime soon. With any company, we want to check the financial strength of their operations, and to do that, we look at these three areas. We want to see whether they can handle their debt, are they growing, and are they a well-managed company? Now, if you're not familiar with the terminology, don't worry at all. Just sit back and relax and just get a feel for what's going on here. So it is really important to look at the company's debt because a business pretty much can't go bankrupt if they don't have any debt. Debt is the number one reason why companies get into trouble. So to see if the business can handle its debt, I went through the debt to equity ratio and the current ratios of the business. I want to see the debt to equity ratio under a 0.7. It really means they can handle their debt comfortably, and EA is well below that. For the current ratio, I'm looking for a number above a 1.5. And for EA, well, it's comfortably above that, no problem at all. So in the finances, to look for growth, I want to look at the book value per share, the earnings per share, the operating cash, and the gross margins. Now, sure, 2020 is going to be an exceptional year, so I do want to think about that when I'm looking at these charts. Now, this is the book value per share, and as you can see, it's solid growth here from EA, so that's a really good sign. Now, as you can see, there's been a big jump in the earnings per share. Now, that was probably a little bit to be expected, but before that, the earnings per share was still quite solid, so I'm happy with that. This is the cash generated from operating activities, and as you can see, a lot more growth here too. Now, gross margins is something that I've started to focus a lot more on lately. I think a company that can grow its gross margins are doing a lot of things right. And as you can see, EA are growing their gross margins, and look, this is a really positive sign. Now, although it would be cool, we can't just go in and sit in with the management team to make sure that they're making some good decisions. But fortunately, there are some telltale signs in the financials that will tell us whether management are making some good decisions. So I'm checking for the return on equity, the free cash flow, and the amount of cash they have on hand. Now, this is the return on equity, and I want to see the return on equity above a 15, as it shows management are improving the value for shareholders. So EA, since 2015, have had a very strong return on equity. I'm very pleased with this. This is the cash that EA have in the bank, and as you can see, it's been improving, which is good. So this is the free cash flow graph, and as you can see, more growth here from EA. Now, EA aren't paying a dividend at the moment, but I'm just really happy to see the free cash flow growing and the return on equity far more than I care about the dividend. So EA have just crushed their financials. So it's all going to come down to what price they are right now in relation to their intrinsic value. So let's go find out. So what I'm going to use is my intrinsic value calculator. If you want a copy of this for free, it's in the description below. Now let me go through the data endpoints that I've used for EA. So I've used a growth rate from years 1 to 5 of 14%. Now that's an average of what the analysts think at the moment. I have to take this with a bit of a grain of salt. I think it's going to grow at about 14% is probably fair. So I'm happy to use 14% here. Growth rate from year 6 to 10, I've just put it down to 10%. I want to be conservative. Now, my return on investment goal here, I've actually used 8.5%. It just rounded up to 9%. Because what we're trying to do is trying to find intrinsic value, not a buy price yet, just intrinsic value. Now, the multiple I could sell it for after 10 years. Normally, I'd want to go as maximum as 15, but the computer game industry averages well over 20, so I'm happy to put this up a little bit higher to 18. So like you can see, I'm playing around with my numbers here just to get a bit of more of a feel for the industry that I'm in. Now, the operating cash flow minus maintenance capex number, I actually just grabbed the free cash flow number because it was easier to find. And that was 1.8 billion. And the shares outstanding are 293. I've actually turned these both into millions. Make sure they're in the same unit here. So I've got them in millions. And now, this is not the price, even though I've got it here as I want to buy it at this price, this is actually what intrinsic value would be. That's what I think the company is worth today. So $200 is just my estimation. Now play around with the different growth rates. If you think things will be better than what I think and what the analysts think, then try higher growth rate numbers. Just don't forget some margin of safety. No one is going to be able to predict this exactly, so you need some breathing room here for errors. So to give us that margin of safety, I'm going to change that 8.5% to around about 20% maybe. I think we could go a little bit more, we'd be a little bit less conservative. I'm thinking maybe something like 18%. That would give us a reasonable margin of safety. So I think $100 would be a pretty good entry point for Electronic Arts in my opinion. Now the current share price as of the end of October is around about $130. Now I do think EA currently is under its intrinsic value of what I think is about $200. But it's just not enough for me to feel good about the margin of safety. But hey, maybe we get lucky and we see a solid pullback down to close to $100, and at that point, I think I'd be buying. So do I want to invest in Electronic Arts? Now, like I already said, I'm not buying them today or probably anytime soon. They're going to go into my watch list because they're a great company, and I'm going to wait until I get a price that I'm willing to pay. I think the future is really bright for the company. They're in a growing industry, and I think they have a good, strong moat around the company. Now, I'd love to hear your thoughts on this investment because I'm sure a lot of people out there think EA is not a good company to invest in, and I'd love to know why. And my next video is going to be on the competitor Activision Blizzard, so make sure you hit subscribe to not miss out on any of my future videos, and I will see you next time.